and welcome to Ensure, your weekly guide to investing in life insurance. Through this series, over the next couple of weeks, we'll be getting to you all the information that you need to know to make the most sound decisions about buying life insurance. Joining in today to answer some of these questions are two gentlemen who are certified to offer such advice. Amit Kukreja, founder of Wealth Being Advisors, a fee-only financial services firm from New Delhi, and Harshvardhan Roongta. He's with Roongta Securities. Gentlemen, thank you very much for your time and for coming into our studios this afternoon. I want to start with you, Harshvardhan. One of the things that really attracts people to life insurance is the fact that there is a tax benefit component to this. Your top-line thoughts before we get into some details.
Well, Bianca, if you see, there are certain benefits which are exclusively available in an insurance product. Now, apparently, there are certain, goals that the government also has when they have, their citizens in mind. There is some kind of social security. There needs to be financial security of the citizens. Now, there are many areas in which government cannot pitch in currently. So in order to motivate individuals to take the benefits of insurance, they offer tax benefits. They give you an incentive that in case you were going to buy a policy in which you are going to pay a certain amount of premium, we will exempt a certain part of your income from taxation. Now, this is an incentive given to individuals to go and actually take something which is good for them. Now, let's understand the tax breaks that are available. We break them into two parts. The first one is when you're making a contribution into an insurance policy, which is in the form of a premium. When you pay the premium, you get a deduction under Section 80C. It's an aggregate section which is compiling of lots of products and a total aggregate of 1,50,000 per annum. So even a life insurance policy premium qualifies for deduction under Section 80C. The other advantage that has been given, a tax benefit that has been given is, in case of a demise or on maturity of the policy, the proceeds that you receive or that your nominees receive are completely exempt from income tax. So the idea is the money that was planned to provide you financial security, if in case that money comes to you in case of demise of the earning member or at the time of maturity, in both cases the money is going to be exempt from income tax. So whatever money comes in your hand is completely yours and you can use it to protect yourself. The section under which it is available, this benefit is available, is Section 1010D. So I think there's a lot that the government has done and to motivate and incentivize individuals to go and protect themselves. So these are the tax benefits that are available, which is also a very big driving force that we've seen in India, has been one of the factors in which people have been actually motivated to buy insurance.
Okay, thanks very much for that. Amit, not all the different categories of life insurance offer the same kind of tax benefits. So a term insurance would give you a certain amount of tax incentive, whole life insurance or even ULIPs, which are market driven. They offer different kinds of tax benefits. Could you outline and highlight which are the ones which make more sense when you're talking about purely from a tax saving perspective?
See, the only thing you have to keep in mind is that when you're taking a product which is giving you a life insurance, the premium should be at least 1/10 of the sum assured. If your premium is more than 1/10 of the sum assured, it does not qualify as a deduction under Section 80C. Okay. So even if it's a ULIP which is offering you a sum assured, ensure the premium is not lesser than 1/10.
Okay. Can you explain that? Can you quantify that?
Sure. If the sum assured is, let's say, 5 lakh rupees, the premium should not be more than 50,000. If it is more than 50,000, then you are covered only till 1/10 of the sum assured. So you'll be covered, which means you'll be exempted or you'll be given a tax deduction of up to 50,000 rupees only. I think that's one big one that people miss out. That's one big one that people have been missold products about that.
Again, and this kind of advice has to come in from the financial planner
It has to come from planner or even the insurance person who's offering the product. He should also make people aware that because the sum assured limitation is 1/10, you should not make more than that. And if it's more than that, then you get deductible only up till the 1/10 value.
All right, Amit. Thanks very much. With that, we're going to take a short commercial break, but don't go away because on the other side, we'll continue this discussion with Amit and Harshvardhan. Harshvardhan, welcome once again to ensure your weekly guide to everything that you need to know about financial planning, particularly when it comes to life insurance. We're still in conversation with Amit and Harshvardhan. Harshvardhan is with us right now from Mumbai and Amit in our Delhi studios. Gentlemen, thank you for staying on with us. Amit, we were earlier discussing, in the first episode of this series, we were talking about how there is an investment aspect to life insurance, and there is also a tax saving and, from a perspective of ensuring your life and the safety and benefit of your family. So if you're looking at purely from the tax saving aspect, are there any red flags that one needs to keep in mind when one is attempting to first enter into the life insurance product space?
So I, in my opinion, Bianca, I think it should be completely decoupled. Insurance is a must-have protection plan. You should not link it with the tax savings that you're making by buying an insurance. You buy a car.
Not just life, but for every kind of
So there's some specific insurances that you should definitely have on board. You don't have to go for tax savings, right? So for example, you buy a car, by law, we have to have a car insurance. I think for human life, we should have an insurance because there are dependents on us. For health, we should have an insurance. So in my opinion, we should decouple it. But if you're looking for specifics, then we have to ensure that 1/10 is the amount that will be tax deductible of the sum assured. The rest, I would say, use the tax ATC deduction for your investments, where you get the benefits of compounding, because there's a tax savings, the more money gets pumped in, and it has a compounding benefit as well. So no, I can't think of any other red flag other than the minimum amount that gets deductible. Ensure you have a good term plan, as opposed to money back plans, because money back plans are investment returns which are not inflation beating in case of insurance product which is offering you money back plans.
So I think often it happens that the money that you get back from money back plans, you actually just either blow it up, you don't consider that as further investment that can go into one of your products or plans.
That is definitely a behavioral aspect, that when you get the money in lump sum back, you don't plan for it. So you should have a plan in place. You should ensure the money that you're getting back in return has been properly accounted for inflation, has beaten inflation. And if an insurance product is not giving you that inflation beating aspect, I would say decouple investments completely from an insurance and have a term insurance, which is a pure life insurance plan for yourself.
Harshvardhan, would that be your suggestion as well, to decouple completely your securities and securitizing your family from any eventuality like death and investments?
Well, Bianca, if you look at the hierarchy and the process, or what do you take on priority first into your portfolio? Yes, first you have to do is you have to buy an adequate life cover, and that you can do only if you buy a pure term plan. For example, if you need a cover of 1 crore of rupees, there is no way that an individual could possibly look at paying 5 lakh rupees as premium in a savings-based product. So he would need to go in for a term plan, the cost of which would be, say, about 15,000 rupees per annum. So if he needs a 1 crore cover, he has to buy something which is available to him within his cost. Now that is going to be available only in a pure term plan. Now having said that, now that is the first step of securing yourself. Now let's look at, as a product basket. All individuals are different in their own thought processes, in their preferences, in their understanding about financial products. The idea is that if an individual has a particular requirement, he should have a product matching to that requirement. So coming from the hierarchy point of view, yes, you need to have a term plan in your portfolio, because that is the only way you can secure yourself in the right amount that you need. Having done that, you can migrate and you can progress into buying either a pure investment product, or you can mix it with an insurance in case your profile requires you to do so. Ideally, you should segregate the two, but if there is a requirement and there are people who are basically not in tune with pure financial products and they would prefer something like this, then there has to be a product available for them as well.
So I guess both of you are saying that a term insurance is definitely something that one can look at. But Harshvardhan, a term plan can actually be for 5 years, anywhere up to 30. Is it possible that on completion of 5, I can continue the same? And if I can, how does that change or alter the tax computation there?
Well, Bianca, actually, it's a very interesting question, and I'm happy that over the last 14 years that insurance industry has been privatized, we've seen a lot of development in the term insurance segment specifically. Now, let's understand the different kind of term insurance policies. As you said, tenure is from 5 years going up to 30 or 40 years is another issue. Let's look at the product features. The first is that you can take a term plan either for say probably 5 years, 10 years, or going up to 40 years. Once you've entered into a contract, you cannot extend the contract. Assuming an example that you gave, if a person has taken a term plan for 5 years, post 5 years, if he intends to extend the same cover, he cannot do that. He has to buy a new policy at that point in time. And that tenure could be, say, again a 5 years or a 30 years as he may suit. Now, the idea is about the tax benefits. Tax benefits are at the time of making the premium contribution. So in this case, where you're talking about a term plan, the premium is definitely a fraction of your sum insured. So in this case, it's not going to be 1/10. The premium is in fact 0.1% of the sum insured. So tax benefits is not a concern. There are another constraints which you need to keep in mind. If you are, say, possibly 30 years of age, you're going to be earning till 60 years of your age. Ideally, you should be buying a term plan for 30 years, because post your earning capacity, if you are going to be covered, you ideally do not have any dependents then. So the tenure of the policy has to be matched with the earning and productive years that you're going to be putting in, and at the time or during that period when you're going to have dependents. Other than that, that's not really required.
Yeah, but like you were saying, this is subjective any which way, and the calculations,
Sure.
obviously there's no one size fits all. Gentlemen, thank you very much for your time. Thanks for coming into our studios and giving us your advice and your thoughts. We'll continue this discussion on the rest of our series every week, coming to you from NDTV. With that, it's a wrap on this edition.